Tax-efficient retirement income. What does that even mean? Probably sounds a little scary, probably sounds a little boring, but for tax nerds like myself, it's actually one of the most exciting things. And one of the reasons that is because that helps you live your goals in retirement. Do you want to go to that bucket list place? Do you want to take your family with you? Do you probably want to put gas in the car and have some groceries too? Yes, but what are the other goals and dreams that you have for retirement, and how are you going to get there? Most people, when they're approaching retirement or just started, they have this nest egg. They say, I've built up this wealth, it's stored of my hours and my time and my labor, but how do I transform that into a paycheck that is going to sustain me and my family for the decades to come in retirement? It's scary losing that paycheck, but it doesn't have to be if you have a clear plan that looks at the cash flow and looks at the tax impact and says, how are we going to provide for those dollars in your bank account? And that's what's exciting about a tax-efficient retirement income plan. When we sit down with our clients, one of the first things we're going to do is look at those goals. What are you hoping to achieve in retirement? And what are those dollars attached to that? Do you want to give charitably? What is the dollar value for that? What is your lifestyle like, and can we sustain it with what we have? Those are important questions we start with, and those give us those expense line items. From there, we compare that to the income. What income sources do you have? Social Security, pensions, rental income, business payouts, whatever it may be, we compare those two. And most of the time, we're going to see that expenses are higher than those income sources, and that's okay. That's what that nest egg, that portfolio is there for. We're going to look at that gap, and we're going to say, how much do we need to pull from the portfolio each year to fill that gap? Ideally, we keep it between 3 and 4%. That's what's considered a safe withdrawal rate. But what we really do is listen to the financial plan that we built. But for anybody doing this on their own, that's generally a safe guideline. Now, once we have that amount we need from the portfolio, we're going to look at those assets. What do you have in pre-tax accounts? What do you have in Roth accounts? And what do you have in taxable accounts? And how are those investments currently situated? For example, what are they? Are they invested in bonds? Are they invested in equities? Are they dividends? Do they not have dividends? And we're going to say, is this the best strategy for that amount we need to take from the portfolio? And is it tax efficient? And that's a whole nother layer as well. But what's an example of a tax efficient strategy? For some of our clients, and not for everyone, this could be, we want some dividend paying stocks in their taxable account. If they're qualified dividends, it lets us have lower preferential rates. Or if it's more growth oriented, then we can control the capital gains and again have those lower preferential rates. That's tax efficient compared to, say, just a bond paying income. It's going to be taxed a little bit higher. But we can't just focus on income, we need to focus on growth, because inflation is one of the most dangerous things to retirees. There's assets wasting away in terms of purchasing power. So we also need to make sure we have equities. Well, maybe we put those in the IRA so that we could have some tax deferred growth. That could work for some people. Or if you have Roth accounts, that's probably where we're going to want to place your most risky assets. Those are your long-term growers that are going to help you beat inflation and be able to fund this plan for the long term. So that's one of the things we look at. The next one, and what is probably most boring to most people, but is one of the most interesting things to me, is something called withdrawal sequencing. Now, what does that mean? It just means which order and which combination of accounts do you pull from during retirement. Now, why does this matter? Well, they did an example of 3 different people. They started with $1.5 million. They all earned the same investment rate. They all pulled the same amount out. The only thing that changed is the order and combination of the accounts that they pulled from. One person pulled from their IRA first, losing that tax deferral benefit. Then they were only left with their taxable account, and they drained that pretty quickly because it's not very tax efficient. They started with 1.5, they ended with 400,000. Not too bad at the end of retirement. They made it, but maybe they didn't get to fulfill that legacy goal of theirs. The next person pulled from their taxable account first and then pulled from their IRA later. They ended up with about 1.4 million. Pretty good, pretty much what they started out as. That third person pulled from their taxable account first, filled up some tax brackets with Roth conversions, and then pulled from a combination of the Roth account and the IRA for the rest of their retirement. They ended up with more than they started. Again, none of this is guaranteed, we don't know this for sure, but it does show the impact of which account you pull from has power over your ending portfolio value and what you can accomplish at your death. So that's one thing that we look at for our clients: which account should we pull from first and which order, so that they can do all of these things. Now, like anything in planning, we have this cash flow plan, we have the income and expenses and the investments and withdrawal sequencing, and then life changes, or ages change, or situations change. And that's why we look at this cash flow plan on at least an annual basis. We want to run tax estimates, we want to check the investments, and we also want to make sure we stay below what's called IRMA break points. That's something we look for too. That changes your Medicare pricing. And that all goes into this cash flow, tax efficient retirement plan. And again, what that means for you is that it is a plan for you and your family in your future to have that paycheck and to be able to enjoy retirement for its entirety. That was a lot of information. Pretty overwhelming, probably still a little boring, but if you have any questions, or if the person you're working with is not currently talking to you about these things, feel free to reach out to us at PY Waltman.